Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
All right, I guess the recording has started. Just bring this down a little bit. This week, we're going to continue our discussion about the alternative assets. This week, we're going to talk about hedge funds, private equity funds, and finally, commodity investment. Commodity investment is particularly interesting for Australian investors. And there are a few groups within the class. They are very interested advising the client to hold on to some gold as an inflation hedge. So probably this lecture will dismiss some of your misunderstandings surrounding investment in commodities and using gold as an inflation hedge. We're going to start our discussion with the hedge funds. So it's not an asset class, not an asset. It's a cluster or it's a very general name referring to any investment strategies that can involve using of leverage, any underlying assets, and any trading strategies as well. But the hedge in the name hedge funds doesn't mean they are supposed to hedge against certain risk. The reason that we have hedge funds in the financial market is because investors would like to generate excess return, not for hedging any risk. And also the hedge is misleading in the sense that there's substantial market risk involved, and it's not risk or market risk neutral. Hedge funds investors have been advertising their products, their skills, for the ability of generating excess return or alpha for investors. Here we have two examples of the first one, a market neutral equity fund. So the funds managers, they're going to raise $100 million from investors. With that $100 million as margin, they can enter into $200 million of long position. They can use their specialties, their skills, buying the undervalued stocks to have a $200 million of long position. So this equity selection should not be in Australia. We don't have that market capacity. So it's usually can be international stocks, not just limiting to the blue chip, the large companies, maybe mid-sized or smaller sized companies can be involved. And also at the same time, the manager can enter into $200 million of short position. They take on this substantial short position in overvalued stocks. So altogether, the net asset of the fund is still $100 million, and they do not have market exposure. So in this sense, it's kind of market neutral. At this time of point, the performance of the fund is not affected by the beta or the overall market movement at all. any excess return generated will be purely driven by the skills of the fund manager correctly identifying the undervalued stocks in the long position and short the overvalued stocks in the short portfolio. To the right, we have a long-short equity fund. It's not market neutral. So still with $100 million raised from investors, the manager enters into $300 million of long position. So they probably believe they have these superior skills identifying undervalued stocks around the world. And at the same time, they enter into $100 million of short position of overvalued stocks. And they decide to use leverage, $200 million. They can use the long position and the cash as margin to borrow $200 million to amplify any excess return they expect to generate from long-short equity portfolios. So the net asset of the fund is still $100 million, the same as the market neutral fund. And the leverage that's calculated in the hedge fund's way, the same 4 times. But the market exposure will be obviously the $200 million in the long-short equity funds. So depending on how the manager is going to implement the investment strategies, hedge funds are not risk-free. They constantly have this huge amount of market exposures, at least in these examples. Is this market neutral fund really market neutral? What if the movement in the long position and short position in a way that out of the expectation of the managers, and the overall portfolio might be exposed to either long or short portfolio movement within the total portfolio. So even though some hedge funds are labeled as market neutral equity funds, they still face market risk. There's no absolute guarantee of zero exposure to market risk at all. That's some structure of the hedge funds. The innovation of hedge funds actually are the expertise of the hedge funds managers. They believe they have superior insights, expertise in one particular area of the market, like equity market, or they have particular interest or passion or expertise in one section, or for example, if it's a macro fund, they probably want to take advantage of the relative macroeconomic development of a group of countries, the currency movement, and all the assets they may have invest interest in. So their investment, the scope of the investment is very broad, much broader than a traditional mutual fund manager. But the question for investors who like to invest in hedge funds is actually, it's always been the high fees and the difficulty of access. For investors who have $1 million of investable cash, so if you decide you allocate 5% of your $1 million cash into hedge funds, sorry, there's no way that you can invest with your hedge funds. Because usually high net worth, extremely wealthy individuals or institutional investors would invest in hedge funds with like $100 million, but not with a few $100,000. And that's the similar problem with private equity as well. With a few $1 million assets like allocated to hedge funds or private equity, investment is almost impossible. There are funds of funds available in the market, but for individual investors, it's really hard to tell your exact exposure in these funds of funds. And the performance is very difficult to predict as well. This is a very important study of hedge funds returns and how much individual investors may benefit from hedge fund investment. although the study was done before 2010, but it's still sending us a very strong signal. And I had some similar studies on hedge funds in recent years, but the key message is still the same. So I decided still to present the older piece because it's so important in our build up the knowledge of our understanding of the performance of hedge funds. So the authors, for that period of time, they classified all of the funds, hedge funds within the database. So these are a group of hedge funds they have reported to the hedge fund database. Remember this, reporting of performance to a hedge fund database is totally voluntary, not regulated at all. So the authors decided, okay, we classify all of the reporting hedge funds into different groups of investment strategies. So for the first one, we have the convertible arbitrage, for example. It's an investment strategy investing in the convertible market. So it can be convertible shares, convertible bonds. And then at the same time, they invest in the underlying shares or bonds of the same company to take advantage of the temporary mispricing of the convertible or the underlying assets. The convertible securities can be considered as a hybrid of the underlying assets and an option to convert into an ordinary shares or whatsoever the class of shares or the corporate bonds. So the demand of this kind of hybrid security can be quite limited relative to the underlying asset, the ordinary shares or corporate bonds. So these hedge funds can take advantage of the temporary market inefficiency. So that's the convertible arbitrage hedge funds. If you're interested, you may have a look at the other classifications of hedge funds investment strategy. So for each of these groups of investment funds, the hedge funds, the researchers try to identify the beta exposure. So that's the total return, the component of the total return driven by the general market movement. And they try to identify the alpha, that's the blue blocks you can see, the bright blue blocks in each investment strategy. On average, that's the overall hedge funds. They find that over that period, with the reporting hedge funds, on average, these hedge funds have generated about 3% alpha and about 4.6% of beta. So that's totally driven by the general market movement. It's not driven by the skills of the hedge funds. And with this, still excess return was distributed to the hedge funds managers. So if you look at the total return of the hedge funds, on average, it's about 11%. So 4.6% driven by the general market movement, and about 7.4% probably driven by the skills of the hedge funds managers, or maybe just luck. But with that 7.4%, the hedge funds managers took 3.4%. So from this decomposition of total return of hedge funds, at least we can tell the hedge funds managers and investors are sharing the alpha, the so-called alpha. And probably, on average, the hedge funds managers took a larger part of that excess return. And investors, on average, are left with a 3% excess alpha, excess return or alpha. So on average, investors still benefit after the fees, on average. But if you look at the return decomposition of different investment strategies, there are quite large variations, especially we have that's dedicated short hedge funds, and also we have the long short equity funds, which got very much higher total return than other investment strategies. close to 14% total return. And in this investment strategy, investors seem to have quite significant alpha, 5% after fees. So for investors who have invested in long-short equities, especially the reporting hedge funds, during that period, they seem had a very significant boost of their excess return. Especially you compare this excess return with any other asset classes, it's very difficult to generate a 5% alpha after fees, after the beta exposure. What's the limitations of this study? If you go into more details of their research, you will find they highlight very important messages to investors who like to invest in hedge funds, because this reported performance is subject to very important survivorship bias and backfill bias. The survivorship bias comes from that these reporting hedge funds are survivors. If any hedge fund is closed due to terrible performance, it's gone from the database. So any bad performance or underperforming is gone from the database. That is estimated to be between 3 to 5% for that data set. So that's similar size as the alpha. So that's one bias, the survivorship bias. Another bias is the backfill bias. So usually the hedge funds, they don't just report their performance voluntarily from the first day of their operation. They usually decide to report to a hedge fund database after some consecutive periods, months, quarters of outperformance. So when they decide, okay, we have tested our investment strategy and we have this stellar performance as track record, and we sort of have the confidence to report our performance and make it a public information, and then they're going to report the hedge fund database. But what about the performance before they decide to report to the database? Okay, the managers will backfill their historical performance, not under any supervision or regulation at all. So hedge funds are not regulated at all. And there's very limited credibility of the backfilled historical performance. So in other words, when you generate this excess return, the alpha, the beta, the total return, especially with the long-short equity of 15% of total return, that means that these averaged out returns include backfilled performance subject to the manipulation of hedge funds managers. This bias is estimated to be around another 2 to 3 or 4% with this data set. So if we take an average, the midpoint of both bias, we're going to have about 4% bias, estimation bias, in this study of hedge funds returns, total returns, and excess returns, which is much higher than the alpha investors take home. So the important message from this study is not just, okay, on average, the survived hedge funds have outperformed the overall market. The other part of the story is that the reported historical performance of hedge funds are not reliable, and investors should not base their investment decision on the reported historical performance. And we do have empirical evidence to show that if you choose hedge fund manager based on the reported historical performance, you're not going to outperform or generate a handsome alpha. But we do have evidence to show that. That's the evidence for average. We do have evidence to show that the top end of the hedge funds managers, they do outperform, they do generate this very healthy amount of alpha consistently over the benchmark. But for investors who have no access to this group of elite hedge funds, it's impossible to have this investment opportunity or have access to this consistent ability, superior ability of these hedge funds of generating alpha at all. Another important message from this study is actually they lay out a method for us to understanding the driver of hedge funds returns, which is still the powerful linear regression. And this, we're going to have a look at the R squared. So that's the, that can be used as a proxy of how much the total return variation can be explained by these factors. So they're just the old school analysis with the stock long-short equity. That's probably the easiest to understand hedge funds investment strategy. So with the long-short equity funds, it's not market neutral, and much of the driver, the largest driver of the total return is the cash return or treasury rate. So that's not difficult to understand. For long-short equity funds, we have that margin, $100 million in the account as margin, and so that you can build your portfolio to borrow from the financiers to set up your total portfolio. So that's why we can observe a 0.8 coefficient estimation of the cash rate. And another important driver is the general stock market performance. Here, for the long-short equity hedge funds, the coefficient estimate is about 0.5. And if you look at the R squared, so with the total portfolio returns, about 55% of the total portfolio return variations can be explained by the three factors. At least we had some good understanding, okay, about half of the return variations can be explained by general market movement, the bonds market movement, and the cash rate. What's the other 50%? Can you guess? What's the other 50%? To explain the return variation of long-short equity funds? Sorry? Inflation? Oh, sorry. Well, I'm not quite sure if inflation can play a part in there. So hedge funds, they exist to generate alpha. How can you generate alpha? Right? Beat the benchmark, their superior skills. So part of the 50% unexplained return variation can be from the investors, the hedge funds managers' variation degree of skills or other factors we can't really pinpoint clearly. And also the other 50% can be explained by the differences of selecting the long and short equity portfolios. Maybe part of it is driven by skills. Maybe it's driven by arbitrary factors like luck. We don't know. Let's have a look at another hedge funds. For example, the global macro. The R squared is about 9%. So the global macro hedge funds, they invest around the world in any assets, in any currency. So obviously, the equity index like MSCI World Equity Index or the World Bond Index or even the Treasury rates, they only explain a very small portion of that total return variation. Can you imagine what the other 90%? What's the other 90%? Just guess. Use your imaginations. With the macro strategies, they really move the money around the world. What risk? Yes, political risk. One important factor, not explained by these factors, political risk. And what else? When you want to take advantage of the macro development strength in different countries, what do? You move money around. Exchange rate, yeah. Only exchange rate movement as well. There's another important driver of the macro strategies. Sorry? Popularity. What do you mean popularity? Popularity, GDP. So basically, you mean they're going to foresee the outperformance of some countries with unexpected growth in GDP, and they're going to move their funds into that country. Market timing. It's actually market timing. So with the other 90% unexplained by these three factors, there are a lot of other things that might be driving the return variation of the global macro hedge funds. Okay, that's if you're interested, you might do some other analysis of this hedge fund performance. But this framework actually provides an important tool in forecasting hedge funds' returns. Especially, you have a good understanding of the investment strategy of the hedge funds in consideration. For example, if your client is very interested in investing in a long-short equity funds, not the average, a long-short equity funds, that's the long-short equity hedge funds. So they invest in global equities. Sometimes they use leverage and short positions to generate alpha. And they have these investment strategies explained in a booklet. And to understand their historical performance, sometimes they do not disclose this to outsiders. So if you want to try to explain or identify the drivers of the investment strategy, you might start from a guess. Something like this. You probably will have the net asset value only, but you don't have their specific asset allocation in the past, but you do have their net asset value. So with that historical time series of net asset value, you might run that based on a few factors. For instance, a passive equity index, or so-called passive bond index, and treasury rate, to identify that R-squared. If you have a very high R-squared, that means much of these, at least majority of that total return variation of that fund can be explained by the three factors. And at the same time, when you run the baseline regression, you may introduce other factors. Some other factors that you guess that can be driving the performance of these hedge funds. You might make the guess from their explanation of the investment strategies. For instance, if they make it clear in their booklet that we are specialized in certain industries, like pharmaceuticals, technologies, you probably want to include these related factors into your regression and try to do analysis like this and see if you're going to improve your R-squared, just a guess. Actually, some funds of hedge funds, they do this kind of exercise. Of course, not manually, but they can use computers to do the trial and error practice thousands of times, and finally they can pinpoint some very possible drivers of the elite hedge funds managers so that they can replicate the performance or asset allocation of these hedge funds. But they offer their products at lower fees or much lower entry point for some investors. Another use of this analysis framework is that actually consider your assignment. With the hedge funds, you are given a much shorter time series data. That's actually when the hedge funds database started. So they started this organized reporting of some hedge funds. That's only started from 1990s. What if you want to go back? You backfill the hedge funds returns, and you might apply a similar methods like this. But at the same time, you need to forecast an estimated performance fee, management fee charged by hedge funds, and forecast an alpha. Because these are explained, and you have to introduce the other factors that you can explain the other 50% of the long-short equity funds. So these are some uses of this kind of analysis in funds management. This is not required at all. You don't need to worry about memorizing that formula to backfill the hedge fund data, but keep this in mind. The concept of this kind of analysis can be useful in the future. One aspect of hedge funds returns is this non-linear payoff. It's not like investing simply in an equity fund. You understand that part of the total return can be driven by the general market movement, and part of the total return can be the security selection skills of the mutual fund manager. But with hedge funds, they have this performance fee in place. Performance fee is only charged on the asset under management when the net asset value of the hedge funds hits a target. So that's usually will be stated when you make the investment with hedge funds. So obviously, that will give the investor non-linear payoff. So before the hedge fund performance hits that target, that will incur the performance fee. Before that, they are going to pay a flat management fee. And after that, when the performance hits the target, the hedge funds is going to charge a performance fee. Another aspect of the non-linear payoff for investors is from the underlying assets of the hedge funds. And some hedge funds use derivatives, so futures contract swaps, options, and so there's a much broader scope of their investment strategy than the traditional mutual fund like equity. So all of these inherent characteristics of hedge funds might make the investors' return from hedge funds quite unpredictable. And in addition to that, with the use of leverage, there might be additional risk for the investor's total portfolio. Although from your asset class, asset allocation, you don't see leverage, but within your hedge fund's investment, you probably have substantial leverage risk. The other aspects of hedge funds investment come from their very unique organization, because they are usually led by an elite hedge funds, and the performance of the hedge funds totally depends on the performance or investment decisions of that particular hedge fund manager. If you can recall that a few years ago, probably the most successful fund manager from PIMCO, that's from the Total Return Fixed Income Fund, he decided to leave PIMCO, and that caused a drain of the world's largest fixed income funds. And also, when he joined another small funds that's actually boosted the share price of the very new funds manager, and also the fund inflow into the new fund by several times. So personnel risk is very substantial for hedge funds. So losing one fund manager, you may just lose investors. They're going to go, the money will go with the hedge fund manager, and you might lose the core competence of your hedge funds, their skills, so-called skills. There are other operational and business risk involved because of their very broad exposure in the risky assets. For example, there might be substantial counterparty risk involved, for example, in the CDS market, or if they use substantial leverage, there's substantial bankruptcy risk involved in a hedge fund. But we do have the evidence to show that the top hedge funds managers, they do outperform. Of course, they charge higher fees, and they come with higher risk for investors. So hedge fund investment is not appropriate for every investor. And also excess is another obstacle for investors who want to invest in hedge funds. If you do want to invest in hedge funds, at first you need to understand the investment strategy of the hedge fund, and also you have some reliable historical performance for you to understand how the funds managers can generate this performance. And also you do have access to that hedge fund manager with a few $1 million. That's not possible. The underlying exposure in hedge funds investment is another consideration when you decide to invest in hedge funds. The exposure, no matter its leverage, the currency risk and political risk, they can be out of your vision. Next, we're going to talk about private equity investment. Just last week, we had, this Monday, we had this investment banking challenge organized by UBS. So that was a leveraged buyout case. So that's something similar related to what we're going to discuss today. So with private equity investment, it's still a quite broad asset class. So they can include leveraged buyout investment or venture capital investment. So it's a private investment. You invest in some startup companies, new technologies, new concepts, new products, and mezzanine financing. Mezzanine financing is sometimes called sandwich financing as well. So it means that they are positioned between the senior debt. So senior debt on the balance sheet of a company, that means they are collateralized. They use the assets of the firm, can be factories, equipment, patents, sometimes intellectual property patents as collateral. So if the company fails to pay the coupon, repay the loan, and you might take ownership of the collateralized assets. And there are uncollateralized loans. So usually they charge a higher interest rate, but if anything happens to the company, you cannot recover anything from the assets of the company because it's not collateralized loan. So mezzanine financing is positioned between the senior debt and the non-collateralized debt. So if anything happens to the company, you might recover part of your money, but not as senior as the collateralized debt. So there are different ways that you can invest in the private companies. That's why it is called private equity. And they are usually structured in a way as limited partnerships with general partners. That's a GP, not general practitioners. They're general partners. So the general partners are usually the private equity managers. They have their own money invested in these private companies and limited partners. So they are usually extremely wealthy individuals or institutional investors. For instance, the pension funds or university endowment funds. Private equity funds, they are usually by vintage. So they're going to raise $500 million from a few institutional investors, and that's it. Because they believe there's an upper limit that they can generate excess return for their investors. So they're going to limit the capacity of the fund to $500 million. And that, they call it a vintage. For instance, a fund name followed by a name, usually it's a year, very long time ago, 1985. So that probably means that that fund was established in 1985, and it's only invested and still investing in a certain group of companies. For instance, pharmaceutical companies, or like a group of companies that are developing rare cancer medications. So that's how they name the vintage, and they usually have their own expertise for each vintage. When the $500 million capacity is reached, they're going to stop accepting additional investors. Instead, they probably will start another PE fund called another name. Sometimes they name it as certain fund like Golden Harvest 1, 1985, and Golden Harvest 2, 1985. So they're going to put additional investors into Golden Harvest 2, 1985, still established in the same year, but probably will have a different investment strategy or different sectors they want to invest in. The money, that $500 million they raise from investors, are not going to be used upfront. So they actually have this promise, commitment from investors. Each of the 5 investors would like to invest $100 million. Upfront, the PE manager decides, okay, we only have one company within our site that we're going to invest in, and we're going to require $100 million only. So I'm going to need $20 million from the 5 investors each. And gradually, when they have this target, usually acquisition target in sight, and then they're going to withdraw the funds from investors gradually, but not upfront. The investment in private equity funds is very long-term, usually 10 years plus. So that's why in the I did search of the private equity database, that's still a lot of funds as vintage that goes back to 1980s. So they are still invested in these private companies. They decide not to exit at all. To assess the secondary market of private equities was non-existent at all about 15 or 10 years ago. So if you would like to sell that private equity investment, you probably will have to make a few phone calls and ask the potential buyers individually. There was no organized market at all. But after 2000, due to the exponential growth of investment in alternative assets, in recent years, there's certain secondary market for private equity investment, especially in the US. That's the world's most active private equity investment. So it's possible that you can sell your private equity investment in the secondary market. But for example, in Australia, there's not such secondary organized market of private equity investment at all. The industry jargons, they often use the multiples. Sometimes they do use the DCF valuation as well as a complement to the multiple valuation. Can you guess why they probably have very extensive use of the multiples instead of the DCF valuation model? Can you guess? Yes, right. There's huge uncertainty with the forecasted cash flow. If you have done 355, the corporate valuation course, you understand this huge amount of assumptions you have to throw into the valuation model to generate that per share estimate. So with a lot of the private companies, the private equity managers invested in, it's extremely difficult to forecast cash flow. A lot of them are startup companies, new technology, and this high risk of assuming anything. So they will just probably want to use a quick and dirty valuation of multiples. And also the historical, the existing deals of multiples can be a good gauge of your valuation of this target firm. So with any private equity investment, they're going to examine similar company, the multiples valuation, and also the past deals. Whenever possible, use these as reference in their valuation of the target. IRR, that's the internal rate of return. That's how private equity funds managers evaluate the expected return from the investment of the private companies. So IRR actually assumes you hold this investment for very long term and can be indefinitely. So that's until a stage you have certain confidence to forecast the performance of the company and to generate cash flow, and you may have this internal rate of return. And also it's an important parameter when they decide if they're going to exit the investment of the company. The J curve, so it's like that's the return you probably want to expect from investment in private equity firms, private firms. Initially, you're going to have very low return. For instance, it's going to be something like this. And then when the value of the firms can be recognized by the market, for instance, if you can list the company in the public market, you offload the shares, you can realize the gains, and that's the value of the firm recognized by the market. Before that, there was huge uncertainty relating to the outlook of the company. Does that curve remind you of any stock price of any company? It's the company and its leader is often in the news story. In auto industry, what's that company? Yes. Have a look at the stock price of Tesla. That's a perfect J curve. A lot of academics still believe the company is overvalued, and probably Elon Musk is another. Obviously, it's a very colorful person. Probably will add a lot of value to that value of the firm. That's the realization of the value of Tesla, but probably in recent months, his very public comments and the way of doing things can be a negative thing for the company going forward. The performance of private equity investment. So it's often measured by internal rate of return, but practitioners and academics are often critical of the use of internal rate of return because it's not the realized return. It's only an estimation of the return you receive from this investment, holding that investment until so-called maturity or exit of the company. And people often compare that internal rate of return, that's an estimate, with the public market equivalent. So public market equivalent rate is the expected return that you receive if you invest that amount of $100 billion in S&P 500. So a passive stock market index. So that's probably will be a good reference of opportunity cost. Instead of investing in the public market, you invest in the private equity market. And also, sometimes they try to identify the factors with the spirits of CAPM or other factor models. They try to identify the drivers of this private equity investment and assess the excess return for investors. Historically, the leverage buyout funds, especially in the US, even on average, they do outperform. So the leverage buyout funds in the US, the managers, they do have the superior skills managing the acquired private funds, turn around some of the underperforming funds, restructuring the assets, and offload the shares when the company is ready to be publicly listed again. With the venture capital funds, on average, they are losing a huge amount of money. Of course, if you have a look at some top end of the venture capital funds, especially those investing in Facebook, Google, and of course, they have generated hundreds of times of returns with their private equity investment. So on average, there's no such outperformance of venture capitals because of the high failure rate of the startup companies. The failure rate of startup companies is well above 90%. So over 90% of the startup companies will fail, will close their doors. Still, this evidence is mostly based on the US. In Australia, we don't have these large-scale private equity funds or leverage buyouts market. The deals are very limited. And statistical inference probably will not be quite reliable with a few observations within your sample. And the access to manager is critical. So similar situation with the hedge funds. With a few $1 million of investable cash, there's no way that you can invest in private equity funds. They usually require hundreds of $1 million of investment as a starting point. Is private equity just another form of equity? They probably are very similar to public equity, that the publicly listed companies, because of course they're going to be driven by the same fundamental drivers, the economic development of the country, for instance, and also the corporate profitability, the cash flows. But they are quite different in terms of these characteristics, especially when you compare private equity firms to the public listed firms. So obviously there will be higher risk, especially with the leverage buyout. Very high leverage is usually used, above 2 times of debt to equity ratios. And also with the venture capitals, you invest in startup companies. Just as I said, over 90% of startup companies will close their doors. So when you start the investment, you understand on average, at least you have 90% of failure rate. So obviously investment in private equity is higher risk due to the characteristics of the investment. And the corporate governance is a huge problem with the private equity investment. The conflicts sometimes are legal battles between the private equity funds, the capitalist, and the founder of the private company are often in the news headlines. They probably will end up in a dispute, legal battles. Of course, that will have a negative impact on the value of the firm. The corporate governance, on the other hand, the corporate governance is not transparent for investors. So it's going to a decision made by the private equity managers, the venture capitalists, the leveraged buyout managers. So investors will have limited access to the corporate governance structures and how decisions are made. And you do not have access to this important information as the publicly listed funds. Like, for example, with any publicly listed funds, investors, if you would like to exercise your right, you got to vote for important decisions. But with the private equities, you do not have discretion on this at all. They usually make substantial changes to the business. That's probably where they're going to generate a lot of conflicts with the founder of the company. They probably view the outlook of the company in different ways, and they have different strategic plans for the future development of the companies. In some cases, when the private equity firms acquire a target or a substantial stake in the target of a private firm, they're going to fire the existing management team and to bring in their own managers and put their own managers on the board to make decisions. To some extent, it's actually a good thing because these managers, they typically have probably decades of experience in that particular industry. They do have the expertise of improving the efficiency of the acquired firm. But for the founders of these firms, emotionally, financially, it's draining to introduce private equity firms for some of them. The sourcing of assets. So with the private equity funds, they are focusing on the private market. Sometimes they do acquire the listed companies and take the company private, but usually they will invest, in most circumstances, they invest in the private market. And also the funding is from private source as well. With the PE investment, it's highly illiquid and very long-term investment. So that means that if the investor does have an immediate liquidity need, or the investment horizon is not as long as the private equity's 10 years plus, probably that's not an appropriate asset for the investor's total portfolio. And of course, the higher cost. With some leveraged buyout funds, even after fees, they can still provide quite handsome alpha or excess return. And also because of the illiquidity nature, the high transaction cost involved, or the big discount you have to offer to offload the private equity investment has to be considered when you make the investment decision. Okay, let's take 5 minutes break. After the break, we're going to talk about commodities. That's probably more interesting.
Exactly, we have done the quantitative analysis part. Finish the price optimizations, and after that we have to go through the heuristic of our investment. We have analysis their risk. Then we'll go for the adjustment part. We will adjust some maybe weights based on the constraint and maybe the risk, the characteristic of our investment. That's right. But my question is, if we want to do the adjustment, for example, if we want to add on more weights on maybe student equity or water hedge or water on hedge, so that point maybe 4% or more 4% or 5%. What will be the guidance that will be, why we add on 4% on it or add on 5% on it?
That's actually a very important question. After you run the baseline mean variance optimization, you get a diversified portfolio. At least you should have the portfolio of expected return. Do I achieve the objective? What about the risk measures? Do I satisfy all of the risk measures? Are there any risks that cannot be easily quantifiable with risk measures but important for the investor? That's this current set of application will actually make the investor exposed to this kind of unquantifiable risk.
Yeah.
So if you have these considerations, first of all, is the expected return okay? If that's above the target, okay, let's just leave it there for now, and then you examine the risk, quantifiable risk measures one by one. For example, if probability of risk, a probability of loss, probability of loss, you miss that target. So you go back to look at the weights of this output from mean variation. So which asset or assets I can make changes to improve the probability of loss?
Yeah.
You test it by manually plugging in the weights, changing the weight. We start from 1%, 2%. And then you go to observe your portfolio outcome again. Okay, it looks like shifting some funds from Australian equity to Australian fixed income can help me to maintain similar level of expected return. But all of the risk measures can be satisfied.
So, which means that it will be not a very quantitative standard for
no standards at all. That's why each group is going to have fully different. If we're going to do asset allocation based on optimization, you're given the same historical data, same expected return, and every group is going to generate the same asset allocation. But that's not the case in practice. We have different beliefs. We have different understanding of the risks.
Yeah, we have already, and in our year statistics class, we have applied maybe some implied views into the mean variance optimization. We have added some our
so
consideration
you
of our.
You forecasted your own expected returns.
Not actually our expected return. We have added some constraints of our maybe our consideration of the
weighting constraints or expected.
The weighting constraints.
Weighting constraints. Yeah. Okay. Yeah.
So after we added more constraint into the solver, and we run the solver, we find that the listed probability of loss is 23.08. Yeah, 23.08. Which
lowest one.
That is the lowest possibility of loss that we can achieve, because and that possible that kind of probability is far more than the requirement of our the assignment of 10%, but we cannot lower this probable loss by changing the weight, because if we changing a weight or do such things like that, we will lose maybe another target, like we lose the liquidity asset requirements, or we'll lose the absolute target of 5.5%.
So what about your tracking?
The tracking error is 1.25%. It's
so
lower than
that's
it's
okay.
yeah. But actually, we do those constraints and those are our target and the requirements of our investor. But what we consider is our probability of loss, and the second is the standard of how we do the adjustment.
There's no such standard or guidance how you might do it. It all depends on the output from your quantitative model, and you take that as and
So
also
you mean that we're
the-
just changing weight by our
your judgment is kind of arbitrary,
just by
based
our
on your-
attempt?
Yeah. So, but there's like some clues you can find from. For instance, if the probability of loss is way much higher than required by the client, so have a look at the highest asset allocation with the portfolio. What about the recent returns? We are based on our analysis, just the historical returns.
Yes.
So have a look at the largest asset allocation within the whole portfolio. It's because of this asset. So obviously, Australian equity is the largest allocation. How much?
23.8.
What about world equity?
10%, I think.
10% total together. Oh, but so
10 or 20%.
So you have
I
like
don't exactly remember.
30% Australian equity, 10% world equity. That's only 40%. What about the other growth assets? What do you have?
Okay. From my remembrance, is the maybe fixed income will be much more weighted.
40% in fixed income,
And
20% fixed income, and
This is after adjusted.
so now we only have 60%. What about the other 40%?
Right. And for the DP?
16% for the direct property, and 5% for the listed property, and there will be some on the market link bond, I think, and
Inflation linked bond.
PE and H bond.
no weights on the PE and
Yeah. Good. So basically, you probably want to have the Australian equity and the second largest portfolio. Examine the recent years, the historical returns, and average performance after adjustment. Are these assets with your loss?
So which means our report need to explain to the customer why the reason why the probability of loss is higher than the requirements.
These are not targets you have. These are
which means that it's not.
It's not a
it's
must
okay.
do. Okay.
You have like 20% of probability of loss. It doesn't mean that will generate 20% of loss in the
Yeah.
future.
Oh, so this 20% of loss is just based on the history of the
And
data.
if you go back to have a look at the historical return, the return of your model, these are very restrictive assumptions. Sequence of the size of the return for each quarter, they are very restrictive. And that's why you need to run another model.
One of our issue is when we do the manual adjustment, it's either we adjust 1%, 3%. This
Margin
amount.
by small margin.
Yeah, so when we write this part of is by our feeling or it's just by some methods.
Yeah, they have the same question.
Your instinct.
We are the same group actually. So.
Yeah.
We are in the same group because
Your
we are.
instinct. That's why your clients would like to pay you $3,000 for that. Your instinct.
So in the yesterday discuss, we have trying to do maybe some quantitative method, like we maybe calculate the distribution of our portfolio return, and we will be calculate
You
the
can do that.
VAR, the
Yeah.
value at risk. If we change maybe do the marginal changing, and we will calculate the value at risk if we do even more changing of our of this kind of this kind of portfolio, we switch maybe 5% out and to another portfolio, and we calculate maybe the value risk. So we find that maybe at some certain level we will be lower value risk, or such things like. But another consideration of our group mates is that because we are writing a report to our clients, not just our boss or not the teacher. So if we add a more complicated model, or
you present very briefly with 1 or 2 sentences describing your method, and then just your analysis, what you find from this exercise.
So which means that we tell him what kind of method we're using, but
very briefly.
We don't tell him that.
We'll not tell him the details why we should adjust maybe only 3% from this, but not 5%, because we just based on our model or our quantitative analysis.
Yeah, I want you to write the report as closer.
So which means easiest to understand as possible. And
if you do want to include this fancy stuff,
no, exactly.
The appendix.
No, exactly, because we want to.
But is that you generate a distribution of the portfolio outcome? That's fantastic.
But maybe.
That's very much rich information for the reader to understand the possible outcome.
So we can attach to.
In the appendix, but not in the report.
But the total word count will be 33,000, included the appendix if we.
It's included.
It's included.
It's in the
based on the requirements.
Yeah.
So make your description brief. But that's usually the case in finance, wealth management, tables, graphs. Explain something.
So much.
No worries. Can we do this after the lecture? We're going to have 10 minutes break. Finish the lecture. In the next hour, we're going to talk about commodities that might be particular interest to a few groups. Hopefully, at the end of the hour, I can convince you that if gold is a good inflation of hedge or commodity investment, it's an appropriate investment for every investor. So that's actually the belief that in the past 20, 30 years, people believe that commodity investment is a fantastic addition to their total portfolio because they appear to have negative correlation with equity, and also they appear to provide certain inflation hedge, for example, gold. I'm going to present you some evidence to support this belief to some extent. But to understand an asset or asset class, we'll start from a very general discussion of the pricing, the driver of that return of the asset class, and its contribution, very importantly, its contribution to the total portfolio context. That's very much more relevant for investors who hold a multi-asset portfolio. So to invest in commodities, these commodities can be oil, gold bars, coffee beans, sugar, all of these are commodities. So we may, first of all, just go into the spot market, buy it with cash. So we may go to buy gold very easily, but probably not very much with coffee beans because you're going to need a warehouse air conditioned with the appropriate temperature, humidity, and security. So with all of this in place to buy and hold the physical commodity. So for so-called investors, we don't go to buy the physical commodity, and we invest in the CCF, that's the collateralized commodity futures contracts. So it's a futures contract, which means that you only pay a portion of the total value of your futures contract upfront, and you have the right to take ownership of the contracted commodities on the maturity of the futures contract. So that's how you're going to calculate your return if you buy a futures contract right now and later on until maturity, you take the ownership of the delivered commodities and sell it in the spot market and take a profit from your position holding to a futures contract until maturity. But that's one way to invest in the commodity. But the investors in commodity markets, we don't wait until the maturity to be delivered the commodities. As an investor, obviously, I do not have security guards to safeguard my gold bars, or I do not have the warehouse with appropriate temperature, humidity to as a storage of the coffee beans. So investors who are not producers of the commodities, who are not the manufacturing companies that use commodities as a major input in their production, they roll over the futures contract. So, for example, upfront, I want to have exposure to the Goldman Sachs commodity index. I go to buy this commodity index. Underlying contracts are going to be automatically rolled over to new contracts when they are close to maturity. So going forward, I'm always have exposure to Goldman Sachs commodity index. That's a group of commodity futures contract, the constant exposure to this commodity market, but I do not deliver or I do not receive the ownership of any physical commodities. That's how it works in the investing of collateralized commodity futures. So obviously, when you decide the investment in collateralized commodity futures price is the key parameter in your calculation or forecasting of your realized returns and expected returns. So next, we're going to have a look at how futures contract price is determined in the market. There are two frameworks. Mainly, there are other frameworks, but mainly we're going to discuss two of these. The first one, that framework is based on storage cost. So this applies to commodity investors or speculators who actually, they probably will have an interest in the future. They would like to deliver that the physical commodity or take the ownership of the physical commodity when the futures contract matures. So that's the theory of storage. The reasoning of how they decide the futures contract is that, okay, I am a manufacturer of household white goods, for example, heaters. We are approaching winter. So basically, my business is going to use steel as the major input in the production. I have two options. I may go into the futures market to enter into a futures contract to have this certain amount of 50 tons of steel delivered to my factory on the 1st of May, or upfront, I can go into the spot market to buy 50 tons of steel and put the steel into the warehouse of my factory and wait until the production to start on the 1st of May. So I have two options as a manufacturer of household white goods. In equilibrium market, the two options should not get me better off or worse off. Otherwise, there will be arbitrage opportunity. So if that can hold, the futures contract price will equal to the net of benefits and opportunity cost incurred as buying the steel upfront from the spot market right now and put them into the storage and for the use in the future. So that's the idea of the theory of storage. So the futures contract is going to be determined by the opportunity cost. That the ST is the spot price of steel in the market right now. And that can be, usually we use the proxy, the treasury yield as proxy. So if you're going to buy the steel from the spot market, you're going to lose the rate if you deposit money in the bank account to generate a treasury rate. That's your opportunity cost. And at the same time, you're going to incur storage cost. For example, the rent of a large warehouse, the security guards, the security system, and probably you have to maintain certain maintenance condition to keep the steel in good condition in the warehouse. So that's the storage cost to buy the steel from the spot market. At the same time, you may benefit from have the ownership of the steel right now from today until future days, the convenience yield. Because as the manufacturer of household white goods, I have the flexibility to schedule the production as to any day I wish. If we have an early winter and very cold winter than previous years, we can start the production much earlier than the maturity of the futures contract, the planned date. So that will probably generate higher revenue for this year because I have the steel in the storage and I can put this into production straight away. I can take up higher market share and probably I can enjoy better brand recognition from consumers and I can benefit from future years of higher revenue. So that will contribute to the convenience yield. The net of the opportunity cost and the convenience yields will be the net opportunity cost. So I believe that will be a market equilibrium futures contract price. So that's one way, particularly for businesses that use commodity as input in their production, they might consider futures contract in this way, that they can clearly identify the opportunity cost and the convenience yield. For other people who invest or speculate in the commodity markets, the theory of normal backwardation is widely applicable. It's going to provide the commodity investors a guide to assess the return you expect to generate from holding on to your futures contract. So in the theory of normal backwardation, that's a theory of Keynes, the theory actually assumes that the property market, no matter it's oil, steel, coffee beans, or sugar, they are actually dominated by hedges. The hedges outnumber the speculators. All of the market participants of commodities, they can be producers of the commodities, like oil producers, and the consumers of the commodities. The businesses that use commodities as major input in their production. For example, the the household goods manufacturers. And also another group of the participants will be the speculators. They have no interest to take ownership of any physical commodities. They have no interest to deliver any physical commodities at all. So these speculators are actually so-called investors in commodity market. They are speculators. So in the theory of normal backwardation, it assumes hedgers, producers and users of commodities outnumber the speculators. So the hedgers decide the futures price, which is here. So the influence from the speculators can be ignored in this theoretical framework. Okay, so the producers of commodities and the users of commodities are going to decide the futures contract price. In what way? So consider the reason that the producers of commodities, they would like to sell forward. So hedgers, they do not try to take a profit from buying and selling their futures contract. They try to hedge the pricing and unexpected changes in spot price of that particular commodity. So they're trying to remove risk or hedge against the spot price changes. So for the producers for oil, they would like to sell forward. Okay, with that futures contract, I would like to deliver this amount of oil at certain dates, like according to my production schedule, at this price. And that's the expected future spot price plus a risk premium. So if the producers of a commodity outnumbers the users of that commodity, the market is considered in normal backwardation. So the producers of commodity has to offer a lower futures contract price, that's a futures contract price, lower than the expected future spot price. That's this one, to attract the users of commodities, other hedgers, and speculators in the market to become the counterparts of the futures contract. So in normal backwardation commodity market, the futures futures contract price is lower than the expected future spot price. And you're going to have a negative, a risk premium offered to the users of commodities and speculators in the commodity market to become the counterparts of the futures contract. So the risk premium here in the formula is going to be negative. So for the sellers of the commodity, it's negative. And they have to offer that discount to attract the users of commodities and speculators to be the counterparts of the futures contract. So that's the case when the producers of commodity outnumbers the users of commodity. The market is called in normal backwardation. Another situation, for instance, that's the supply exceeds the demand. In some commodity market, for instance, after a huge jump in coffee beans or some agricultural produce, and there may be a boost of government subsidy of growing coffee beans or soybeans, for instance, and for a period of time, you probably will have supply exceeding the demand. There will be like a sudden increase of demand from the newly industrialized countries, for instance, the emerging countries, the rise of the middle class consumption of sugary things, and there might be an increase of demand of sugar. So in this market condition, there will be higher demand exceeding the supply. So with the manufacturers of chocolates, lollies, they would like to buy forward. They would like to lock into a futures contract to buy this amount of sugar at this maturity of the futures contract to lock into this price. So in this case, demand exceeds the supply. With the buyers of sugar, they have to offer a premium to attract the producers of sugar or speculators in sugar market to become the counterparts of the futures contract. So in this case, they're going to offer a higher futures contract than the expected future spot price of sugar. And in this case, the risk premium is going to be positive. So these are called normal backwardation and contango commodity market, depending on the balance of supply and demand in that particular commodity market. This normal backwardation or contango is not static for any particular commodity. So it can be sometimes it's normal backwardation, and after a while when the demand exceeds the supply, it can be in contango. And afterwards, when the supply catches up and the demand drops, and the commodity might be in normal backwardation again. So this is a dynamic process determined by the relative balance of supply and demand in that particular commodity market. If you're interested, you can do a very simple search. Have a look at the major commodities like oil, sugar, steel, soybeans, corn. Have a look at if they are right now in contango or normal backwardation. And given your understanding of the development in the world economy, you probably can make sense of why this commodity is in normal backwardation and why this commodity is in contango. So this can change. Okay, this is the understanding of how we can price futures contract in the normal backwardation theory when the hedges outnumber the speculators. The drivers of total returns for investors or speculators, as we can see, is going to be determined by the collateral return, so when you invest in collateralized commodity contracts, you probably will only need to pay 10% or 20% of the total value of the futures contract as margin in the margin account, and until time t, capital letter T, you're going to have the ownership of the physical commodity. So over that investment horizon, much of your return is going to be determined by the collateral return, the margin account return. It's usually closely follow the treasury yield, interest rate movement. And another important factor will be the unexpected changes in the spot market, because it determines the futures contract market, a futures contract price. As investor in the collateralized commodity market, we don't wait until maturity. We always roll over our futures contract. So your total return from holding on to that commodity futures contract will be partially determined by the treasury yield, that's the margin, and also the yield, roll yield. When you roll over the futures contract, the difference, the changes of futures contract to remain the same exposure as you desire. And also in turn, that roll return is going to be determined by the size of risk premium, that's relative balance of supply and demand, that property of that commodity, not property, and also the unexpected changes in the spot price, or that's the price return in the jargon of commodity investment. So these are the drivers of total return for commodity collateralized commodity futures contract investors. We're talking about investment. Very few investors holding a multi-asset portfolio will be interested in buying the physical, holding on to the physical commodities. So the risk premium is a very important driver of the expected return from the collateralized commodity futures, and also other factors, the roll yield and the unexpected spot price or price returns. So that's the drivers of the total return of commodity investors. And now I have the evidence from that's still important work to help us to understand the role of commodities in a multi-asset portfolio. So in the first of this table, the upper half of the page, we have the annualized returns, that's realized returns, and standard deviation of US, that's US, stocks, bonds, and collateralized commodity futures, which is the Goldman Sachs Commodity Futures Index, which has about 70% exposure to energy. So that's an investable commodity index. Over that period of time, about 50 years, so we have the collateralized commodity futures return realized at very similar level to stocks, American stocks in the same period, and much lower standard deviation. That's 12% compared to 15%. Okay, for any US investors who hold a balanced portfolio, for instance, 30% in growth assets, 30% in defensive assets, it's very obvious, including collateralized commodity futures contract investment in the total portfolio will improve the risk-return trade-off of the total portfolio because of the negative correlation of commodities with equity. Remember this, for a balanced portfolio of 70-30% asset allocation of growth assets and defensive assets, over 90% of the total portfolio return variations are driven by the stock market movement. So introducing commodities, especially CCF, into a total portfolio will actually reduce your total portfolio standard deviation, but not sacrificing too much total portfolio return. So that appears a quite good new asset into any US investors. Another strong belief or strong reason that some investors would like to invest in commodities is that they believe commodities and sometimes gold, they are good inflation hedge. And these researchers, they did the research based on the same sample period from 1959 until 2004. And they have this correlation, quarterly correlation of stock return, bond return, and collateralized commodity futures returns with different components of inflation. So now we have total inflation, that's the realized inflation, and change in expected inflation. How do you calculate expected inflation, by the way? Can you recall that from last week's tutorial? How do you calculate the expected inflation from 2 time series data? Can you recall that? Yes, exactly. So that's a rough proxy of expected inflation captured by the yield difference between nominal bonds and inflation-linked bonds. So that's the change of the expected inflation. And another component of the total inflation realized is the unexpected inflation. So, or in other words, the yield difference of nominal bonds and inflation-linked bonds is not a perfect measure of the expected inflation. There are always some unexpected inflation. So they run the correlation of the asset returns with different components of inflation, and they do find very strong evidence to support the belief that commodities are good inflation hedge for US investors for that period of time. Okay. Does it hold in Australia? That was until 2004. Does it still hold now? That's probably a very relevant question if we're going to use something similar or use that piece of evidence to recommend investing in commodity for your client in your assignment. So obviously in your assignment, you have an Australian investor, total portfolio all denominated in $8, and the time is 2019. Are you going to use that piece of evidence in your analysis and in your recommendation? Probably you have to reconsider your recommendation if you believe investment in commodity or gold can provide inflation hedge or diversify the total portfolio risk for Australian investors. So that's probably a very important challenge. The next table shows the evidence that how including the commodity futures contract in the total portfolio can improve the risk to return trade-off of your portfolio. So the first column, we have the portfolio without the commodity exposure and portfolio with 10% commodity investment, and we see the annualized portfolio return at very similar level when you introduce commodity exposure, but you're going to reduce the total portfolio risk standard deviation when you include commodity investment. The difference of that Dow Jones AIG Commodity Index with the Goldman Sachs is actually they have different exposure to commodity sectors. With Dow Jones AIG Commodity Index, they have a limit to any particular sector, for instance, energy, up to 33%, or agriculture, 33%, up to. Dow Jones Commodity Index was later sold to Bloomberg. So it's now called Bloomberg Commodity Index. If you read from the news of Bloomberg Commodity Index, that's the same as Dow Jones AIG Commodity Index in this study. So that's an evidence for the US investors. And the challenge is actually for Australian investors. Does it hold for Australian investors? I would like to remind you that the spirits of fundamental risk analysis is very useful to understand the concept, to have an answer. It's very straightforward. I'm an Australian investor. I hold 30% Australian equity, $8, 30% world equity hedged, $8, another 20% in listed and unlisted property, Australian assets, $8, and how much I have now? 30, 30, and 10. So I have another 30% in Australian fixed income, world fixed income, $8. So that's my portfolio for Australian investor. Is commodity a good addition to my total portfolio? What's the fundamental risk of my total portfolio? Anyone? What's the most important fundamental risk of my total portfolio? Australia economy, excellent. So the single yes, exactly. So with my existing portfolio, I have 90% of my total portfolio return variation driven by the Australian stock market movement, which is in turn actually can be considered as a leading indicator of Australian economy, and which is largely a commodity economy. I asked you in the first several weeks, asked you to have a look at the GDP data from ABS, have a look at the growth rate, the cut of the pies. Australian economy is a commodity economy. Australian currency is a commodity currency. So with my total portfolio, I have substantial concentrated risk exposure to Australian economy or commodity. So intuitively, introducing commodity into my total portfolio, is it a good idea? Probably no. It's going to increase, maybe not neutral at all, it's going to increase my exposure to commodity or Australian economic risk. That's the fundamental risk analysis, the spirit from that framework. You can apply this to a lot of different contexts. Is it still relevant now? If 20 years ago, 30 years ago, commodities was inflation hedge, is it still an inflation hedge? What do you think? Not really. Why do you believe so? Why do you think 30 years ago commodities gold might be a good inflation hedge? What happened in 1970s and 80s in the commodity market? Recession? Yes, there was recession, and actually recessions across the world triggered by what? Not sure if you're going to know this. Well before you were born. Yes, 70s and 80s. Why there were worldwide inflation and recessions in a lot of countries? Some sort of yes. And afterwards, what happened with the commodity market? Hey? Yes, oil prices. A few oil prices. The conflicts, the falling apart of the pact, and the oil crisis in 70s, 80s, actually, that's part of the reason that for that period of time, gold was an inflation hedge. And investing in commodities did improve the risk-return trade-off for investors for that period of time. Now, I did this exercise for Australian investors. Let's use some recent data and have a look at the numerical evidence. So, I'm sorry. So for the first table, I have the correlation of commodities and major asset class returns, equity and bond. So they are all Australian equity, Australian bond, and the commodity index I use that is Goldman Sachs commodity index. So I did the correlation of commodities with equities and bonds for the entire period from 1984 until 2019. Oh, sorry. That's not the case. Commodities had a slightly negative correlation with equity, but very close to zero. So, which if you take a very long-term view of that 40 years, nearly 40 years, investors might benefit investing in commodities because with that additional asset, it obviously has a negative or close to zero correlation with the major driver of my total portfolio. If I split my total sample period into sometime from 1980s until the early 2000s, and from 2006 until February this year, actually have very different results of the correlation between commodity and equity, Australian equity. So until 2005, Australian equity was negatively correlated with commodity returns, and that correlation is significant at 5%, 95% significant level. And for recent period, after 2006 until February this year, the correlation between Australian equity and commodities has been positive 0.17 and significant as well. So we observe a sharp reversal of the correlation of Australian equity and commodity index, all returns in $.